This is a Mining Interactive video production.
Good afternoon. This is Nick Nicholas here to welcome you to Mining Interactive University, MIU. And I'm here today for this inaugural lecture with Dr. Michael Berry. Dr. Michael Berry is a pioneer in the emerging field of discovery investing. He researches and writes on companies that focus on discovery in the natural resources, high technology, and biotech sectors. While at the Darden School, University of Virginia, he was a professor of investments and has held the Wheat Endowed Chair at James Madison University. His research in the study of behavioral strategies for investing has been published in numerous academic practitioner journals. He publishes morning notes on a daily basis and discusses geopolitics and their effect on capital markets. Morning Notes is a daily letter on discovery investment and subsequent wealth creation. And that's what it's all about, wealth creation, which certainly is important in these turbulent times. Over the past years, Dr. Berry has been very strong on the commodity sector, and he speaks at many commodity or hard assets conferences. Over the years, we have come to realize that at universities, investing was not being taught, and there was a real need to lecture on real-world investing. Today, we would like to try and remedy that with our first lecture, which we hope will assist university students and high school students alike before they enter their postgraduate lives by lecturing on real-world investing 101. It's a pleasure now to introduce Dr. Michael Berry. Dr. Berry?
Nick, thank you.
Thank you.
Well, it is a great pleasure to speak to this class today and talk about a passion of mine. And just to give you a little background, I have been a professor in both graduate school and undergraduate, teaching investments and corporate finance for many years. And I really found that in the 1970s and 1980s, the idea in university was that all markets were efficient and it was very difficult to beat the market. And I think I bring something different to it. But what happened to me in my career was that I left academe in 1994. I left a tenured professorship and went to Wall Street. And I became a value investor, and I worked with some famous investors. David Dreman was one, and Bill Naskovitz at Heartland Advisors was another. And I learned a tremendous amount from these gentlemen. But one thing I also did learn is that once you're in a style, whether it's a growth investor or a value investor, whether it's small cap or large cap, these different investment styles can go out of favor, and they can stay out of favor for a long time. And I'm sure many of you today will remember that in 1999, oil was trading for $10 a barrel, or maybe you don't remember that, but in fact it was. And I was buying oil stocks because I knew that oil couldn't stay there. But the problem with that is that sometimes the market stays out of whack for a very long time. So after my stay at Heartland, which I greatly enjoyed, I decided to develop a new technique that would really allow me to teach people how to invest in the discovery cycle, because my belief is that discovery never goes out of style. If you make a great world-class discovery in your future careers, whether it be a discovery in biotech, maybe it's a cure for cancer or a procedure for Lou Gehrig's disease to help solve that problem, or whether you discover a great new uranium mine or a gold mine, or maybe it's oil that you discover, those discoveries, if they're good enough, they will always be valued well by the market, no matter whether you're in a recession or not. You know, and the other thing is in discovery investing is that we've had a horrible 18 months now of a recession in both Canada and the US. And it's really put a hole in a lot of people's wallets. And so what I want to do today in the next half an hour or so is talk to you about how you can remedy some of these situations and give you a new lease on your investing life. So I'm going to talk about discovery investing. I've entitled this The Wealth Creation in Troubling Times. So the first question, I think that's a fair question to ask, and I hope I can answer it, is what is discovery investing? First and foremost, it is an investing discipline. In other words, there are rules. And I'll go over some of those rules as we go through this lecture. It is an investing discipline primarily focused on early stage speculative investments with the potential for significant wealth creation. Now that's a mouthful, I understand that. And the word speculative bothers some people. But you know, everything we do in life, but especially in the investing sector, has some element of risk and speculation in it. And what I teach in this seminar is how to minimize the amount of speculation, make it your friend and not your enemy. Minimize the amount of risk, make risk your friend and not your enemy. So discovery investing is a discipline. There are rules to apply to it. It focuses on early stage investments, and it relies on the fact that if you make a great discovery, again, whether it's in the resource sector or whether it's in the biotech sector or the high-tech sector, and I'll name there are many, many different ideas, and it can be so much fun for you in this area, that the capital markets, the stock market, will discount potentially world-class assets. Now, discounting is that process of looking at an asset and bringing back to today what that value really is in terms of share price. So we focus mostly on stocks that trade. And just to give you a couple of examples of great wealth-creating opportunities that I've been personally associated with, one was called the outcrop at Peñasquito. And the outcrop at Peñasquito in the Mexican state of Zacatecas was one little outcrop in the field, and we, over a period of 6 years, we drilled 700, 800 holes in this field, and we discovered 1.8 billion ounces of silver, 25 million ounces of gold, and billions of tons of lead and zinc. And so that stock, which was eventually bought out, it was originally Western Silver, was the incubator of this whole process, was taken out by Glamis Gold, and then Glamis Gold was taken out by Goldcorp. And Goldcorp owns the asset today. But this is the essence of discovery, creating great wealth through a discovery like that. And the second one is a Canadian research. It's the gene. It's in every human, it's in every animal, it's in every plant. The gene is called factor 5A1. It's just a name, but the gene is responsible for cell death. So this gene, and it was developed at the University of Waterloo, in Waterloo, Ontario. The discovery was made by a plant biologist, and they found out that in humans it works very well. And so you all may know that cancer cells are horrendous and they don't want to die. They hang around for a long time. This gene can be modified so that you can kill cancer cells. And so the company that has this gene is going to be in clinical cancer trials either late this year or early next year. We're talking about spring of 2009 now at the Mayo Clinic, and they'll be testing this gene on humans that have multiple myeloma. If this works, and we think it will because it's killed every cancer in mice that it's come across, if this works, then this will be a great discovery. This will be a game-changing discovery, and it will create great wealth. So those are the things we look for. Now, I know what you're saying is, do you always find these? And the answer is no. Some discoveries, processes just don't work out. And so you have to diversify, and I'll talk a little bit about that as we go forward. What drives discovery investing? Well, it is driven by the very strong force that we all experience for a higher quality of life, but especially if you think about it now in terms of China and India and Brazil and Russia and the people that are living at substandard levels of lifestyle, they want a higher quality of life, and the only way they're going to find that is by continuing to make discoveries, whether it's in healthcare or the resource sector, whether it's in high tech, so that these 5.5 billion humans are going to want to have a better quality of life, and that will be dependent upon the copper and the lead and the zinc and the gold and the oil and the natural gas, all the potential discoveries that you can think of that we're going to have to support them. However, given the recession that we've been through and that we're still in, it is also driven by the realization that over the last year, 30 to 50% of the world's wealth has been destroyed. If you go back to July of 2008 when we had the biggest turndown and investors everywhere lost 20, 30, 40, 50, 80% of their wealth. So now we have to replenish that wealth. And the way I think you need to do that is by looking at discovery. Do you do this for all of your portfolio? No, you do this for a small piece of your portfolio. because the discovery wealth that you will create will be very significant if you make a large discovery. Now, why do I suggest discovery? Well, as I mentioned before, I've been a fund manager, I've been a professor of investment, so I've taught the theory and I've walked the walk in the investment world. And I recognize that if you pick a particular style, that investing style, again, it could be growth or it could be value, it could go out of favor for a very long time. And of course, that happened to me in one of my stints on Wall Street. And so I wanted to find a sphere that would be exciting for people, where they could learn a tremendous amount, where I could teach them a tremendous amount. And discovery is absolutely an untouched investment space. Discoveries happen up front. Oftentimes they're serendipitous. What I mean by that is that you get something you don't always expect, but lots of times it's good. And so when you're out there looking for discoveries, sometimes you find things that you don't expect to see. But if you're not out there looking, you won't find them. It's an adjunct. Discovery investing is an adjunct to your retirement funds. You don't do it 100%. You make it part of your portfolio. So I would say that if you're considering this, you take 5% or 10% or whatever you feel comfortable with, and you put it into the discovery space. And by that, I mean you buy stocks that you think have the potential for discovery. Very often, but especially in this environment where commodities, for example, have really been hit very hard. You've seen oil has gone from $147 to $37. Now it's back up to about $70 as I speak. So oftentimes the best time to invest in discovery is when it's a contrarian environment. It's very much independent of the business cycle. So these are two really good things to have. It's hard to be a contrarian, but I learned that in my career on Wall Street, and it's something that you deal with. Have a feel. For example, today natural gas is selling for about $4 a thousand cubic feet, and it's way, way undervalued. And it's unloved, it's unwanted. But a discovery in natural gas will create great wealth. So that's just an example that I give of discovery investing. The other factor that's probably the most important for all of you here today is that it has a very large wealth creation potential relative to traditional strategies. And why is that? That's because you're at the front end. You're at the front end when there's almost no value in the stock that you're looking at because maybe the discovery hasn't yet been made. And so that once you make that discovery, whether it's a drill hole or whether it's a clinical trial in the biotech arena, or maybe it's Apple's new iPhone system. I mean, it goes across the spectrum. And once the public realizes you have a discovery, they will bid the stock, almost irrespective of how good the discovery is. Why do we need discovery? Well, I've touched a little bit on this, but China is still a very major player in the world. People have said, well, there's 1.3 billion Chinese, and China has not decoupled. They're going through a difficult situation. But I went to school in China 41 years ago, and I've watched China grow. And over the last 40 years, China has become a major player on the world stage, and they're not going to stop. So we have this global quality of life cycle. It began in China under Deng Xiaoping in 1979. It will last another 2 to 3 decades. Once we get through this recession, you're going to see growth in China. You're going to see growth in India. What we call the BRICS, Brazil, Russia, India, and China, they will all start to grow again. And that growth will be predicated on the people in those countries wanting a higher quality of life. It will require the discovery process. We will have to discover minerals, energy commodities. We'll have to figure out new ways of building agricultural commodities, new discoveries in the ag space. And of course, Canada is way ahead in many of these areas. Also, what we see happening today that makes discovery important is what we call resource nationalism. It's the second point on the slide here. And in this case, you know that just as an example, but it's happening everywhere, but Russia disallowed foreign control of their companies, of Russian companies, in July of 2008. They suspended natural gas distribution to the Ukraine and Western Europe in 2008. And as of June 2009, the U.S. government decided that they would buy all of their uranium from the Russians. So there's this sort of resource nationalism happening now, and it's going to mean that there's a higher premium on discoveries because if you take a look at Venezuela, they're nationalizing everything, and Iran is doing the same type of thing. Finally, we need discovery because there are 87 million, I estimate, 87 million relatively impoverished U.S. and Canadian baby boomers. Now, I'm entering the baby boomer phase, so I know what I'm talking about here. Many of these baby boomers have just been through the most gut-wrenching wealth destruction cycle of their lives, where they thought they were going to retire in 2 or 3 years in a comfortable lifestyle, and they found out now they have 50%, 30%, 20% less wealth. And so they need to be in the discovery space. Many of them don't know it yet. But this is why I go out and speak about this particular investment discipline. They must create additional wealth due to their pension declines, vanishing safety nets that we see, particularly in the U.S., the decline of fiat currency, and you all know what I mean by that, the decline of the dollar relative to other currencies and relative to commodities, and through inflation and through tax increases. Okay, so what about China and India? They have what we call a nascent or beginning QOL cycle, quality of life cycle. And this is where people are now learning about televisions and cars. You know, I lectured in China in the 60s, and I went back there and talked to the Chinese government in 1995, and I took my wife with me, and we asked the Chinese government, you know, what is the goal of the government of China? This was 1995, and the official guide said, the goal of the government of China is to electrify every home, and that means one light bulb in every home. Now, I can assure you now the Chinese want color TVs in every home. That's the quality of life change that I'm talking about. And you have to have discovery to be able to do that. You have to create wealth to be able to do that kind of increase of quality of life. So, you know, it is not now dead. This is from Professor Jared Diamond. He had a New York Times op-ed piece in January of 2008. Jared Diamond is famous for Blood, Germs, and Steel. It was a book he wrote, and I recommend to everyone in here that you should read that because it's really about this increasing quality of life in the world. This is what he said, and I'm quoting him now. If India as well as China were to catch up with Canadians and Americans and Europeans, world consumption rates would triple. Okay, now if world consumption is going to triple, you better be discovering the kinds of assets that can support that tripling. Whether it's copper or whether you're growing more wheat, you're finding out how to create more food, how to process more food. These are all the discovery issues. If the whole developing world were suddenly to catch up, world consumption rates would increase by 11 times. So where we are today in the U.S. and Canada primarily and in Western Europe, you can multiply that consumption rate by 11, and that's the kind of consumption we would have to have. It would be, Professor Diamond says, it would be as if the world population ballooned to 72 billion. Now, the only thing I can really stand up here today and assure you all of is that the quality of life cycle has not been derailed. Once people understand that there's a better life available, I can assure you the Chinese do, I can assure you there's an awakening in India and in Brazil and in Russia. They will not cease until they have that better quality of life. Professor Diamond says, some optimists claim we could support a world with 9 billion people. That's the current forecast for the population in 2050. But I haven't met anyone crazy enough to claim that we could support 72 billion. Think about that, 72, the effect of 72 billion people all desiring automobiles and televisions and a better home and the nutrition necessary to live. So discovery investing will only become more critical as we go down the road. And now I think we talk about some good examples. The strange case of oil, of petroleum. It's a dirty word in Washington now because of the environmental impact of some of these fuels. But does anybody in this room want to live with less? With less gasoline, with less petrochemicals, with less of the elements? Every single economy in the world today is reliant on cheap energy. That's the primary driver of the quality of life. And so we must discover more energy. We must have alternative energy, that's for sure, but it is not yet competitive with oil. So here you see the graph going back to 2006. It's a 3-year graph. And you can see how oil went to $145 at the peak, and that was in July of 2008. And then the world collapsed, and commodities collapsed with it, and oil fell from 145 to 32.71 in this graph here. And now it's gone back up. So we're in the process now of bringing more and more discovery companies back into this market in order to discover the energy sources that we're going to need. I know many of you here are probably strong environmentalists, believe in the green movement, and I believe in the green movement too, but it will not be here for another 10, 20, or 30 years in full force. So we're going to have to rely on fossil fuels. That means we're going to have to discover fossil fuels. That means you have an opportunity as an investor to invest in these in these companies that are exploring for the fossil fuels. What about the US dollar? It's very important because most commodities, most assets in the world today that are traded are valued in US dollars. And here you can see tremendous volatility in the dollar. The dollar fell down to 71 cents in March of 2008. The Canadian dollar moved much, much higher, and it was a great investment to be short the US dollar and long the Canadian dollar. But that's not a discovery investing, that's a speculative trade. It's a trade in the currency market. But here you can see the dollar increased in value significantly over the last year or so, and now it's fallen. So that I think you're going to have commodity prices be very strong as we go forward. What does that mean for you? Well, if you're a discovery investor and you're looking in the resource sector of the discovery space, it'll be very good because the price of copper, the price of lead, the price of natural gas, the price of oil should go up with a weakening U.S. currency. So this is a good time to be in the discovery space. This graph is the Morgan Stanley Commodity-Related Index. It is an index of 20 large-cap commodity companies. And you can see how badly they were hurt in the decline. They fell from over 1,000 points to 363 points. That's 70% decline. So this has been a absolutely devastating decline in the marketplace. And again, how do we replenish those assets that we've lost? And one of the answers, not the only answer, but one of the answers to you in the audience tonight is to look at discovery as a part of your portfolio because you'll get some big returns. And we've actually seen since last October, we've seen a pretty good run-up in the commodity stocks that are in this index. You can see it's now resting at about 660. So it's only off about 40% from where it was. Now, I want to just do one example of a company, and I don't own this company, but I want to give you an example of the wealth that you can create through discovery. This company is called Canplatz. It's a Canadian stock, trades on the Toronto Stock Exchange Venture Exchange. And Canplatz made a discovery in October. If you look at the graph, you'll see in October of 2007. And look at the tremendous value creation. Stock was trading at 20 cents. When the drill came out of the hole, they knew they had a discovery hole of gold. Again, it's in Mexico. In fact, the discovery hole CR06, if you look at the graph here, intersected 183 meters, averaging 1.61 grams of gold per ton. That's a pretty good intersection. 12.84 grams of silver, a little less than half an ounce of silver, 0.5% of lead, and 0.33% of zinc. The stock went from 20 cents to $3.58 in its first run. Then it ran up to $5.28. And even though it's been through this tremendous downturn in the markets since July of 2008, it's still selling for $2.31. So if you had purchased 1,000 shares of this at 20 cents, you would have put $200 essentially. Let's just round it out. You would have put about $200 into this stock in October of 2007. And even after the decline, this terrible decline in the market over the last year, you would now have $2,300. So this is the kind of gain. This is what we call, in the slang term, I guess, if I can use it, a 10-bagger. And, you know, again, I know what you're thinking out there. You're thinking, well, does this always happen? And the answer is no, it doesn't. But if you diversify properly, as I'll show you in a minute, it can help you. The past 6 decades now transmogrify to the future. I know you're all in the audience. I know you know what transmogrify means. It means transforms badly to the future. So we will return to new growth engines. I think that the BRICS and the BRACs, Brazil, Russia, India, and China, Brazil, Russia, Australia, and Canada, have now come of age, and they're going to play a new role in the economic reestablishment of the world. The positive sum Western world is now at risk. By that I mean I think our quality of life has to pan out a little bit here, has to flatten out. Discoveries will be critical to world growth and to increased quality of life. I know I've stressed that several times. And the extractive industries, the mining industry, the lumber industry, the oil and gas industry will return to prominence, but they will lag in the U.S. But the key element I want you to remember in tonight's lecture is discoveries in cheap, cleaner, conventional energy, fertilizers, water technology, healthcare, and alternative energy sources will be of utmost importance, and they will be valued accordingly as they are discovered. What are the milestones? What things do you look for? I've mainly talked about resources tonight because I enjoy that. I enjoy working in the resource industry. But this world is wide open for you. For example, nanotechnology, which is where we work with very small particles of metals and other elements, are being now used for electrical transmission, for semiconductors, for lithium batteries, for the new battery technology, infectious disease treatment, vaccines. We've all heard about H1N1, the flu virus. They're working hard to make a discovery in that area. What about the environment? CO2, carbon dioxide capture and sequestration, figuring out how do we deal with carbon dioxide. We're going to need discoveries there. Hydrogen fuel cells are still in their infancy, and so some of you may even work in that industry. But you really don't have to, and that's the key thing about discovery. You can invest in these industries if you have an interest. And it makes it a lot of fun. It makes investing a lot of fun. So there are other things here. Fuel technology, nuclear fuels, gas to diesel, coal to liquids. All of these technologies are coming down the pipe. And there are companies out there today that you can look at, you can learn about, that are doing these things. You can see the rest of these, and this is only a partial list, and so I won't spend any more time on it. But in another lecture, maybe next week, we'll go through these in particular and talk in more detail. I just want to give you tonight a flavor of the kinds of things you can get interested in from the discovery perspective. Okay, how do you do it? This is probably the guts of it, the most important part, and I think that I've worked on this a long time, and this was sort of the whole essence of my study of discovery. There are 8 steps to discovery investing, okay? And you do them in order, 1 through 8. And these will make sense to you, I think, as we go through them. First of all, you need to think about your portfolio. You need to have a plan for allocation of assets. Do you want to be in stocks or bonds? Or do you want to be in hard assets? Within this, do you want to have a discovery portfolio? And you have to put numbers on those. You have to decide whether you want to be 5% or 10% in discovery, and whether you want to be 40% in bonds and 60%. And lots of times, for those of you who are not really experienced at this, you hire a financial planner and you learn from them. But we'll talk about this again in the future too. Secondly, most important, this is the mistake most people make, is they do not diversify. Diversification cuts your risk down. Now, in the discovery space itself, you should own 10 stocks. If you own 10 stocks and you have discoveries, good discoveries in 2 or 3 of them, you will create more wealth than you would ever believe, even if you lose in the other 7. So diversification of risk is critical to the discovery issue. So, you know, you want to buy enough of each stock, but you want to have enough stocks to make sure in case something goes wrong. You need to then think about how much risk you want to take. Do you want to take a lot of risk? Do you want to invest in the early stocks that haven't yet made the discovery? Or do you want to invest in stocks that have made a discovery, but they aren't recognized by the market yet? So we call those more mature discovery stocks. Or maybe you want to invest in a significant oil company that's already made discoveries and is making more. At each level, you take more risk. And then for each stock, you figure out what's your downside. So now you go back to each individual stock. What's my downside and what's my upside? In discovery, you want your downside to be about 10 times less than your upside. So if you buy a stock for 10 cents, how much can you lose? You can lose 10 cents. But maybe that stock has $1 potential, like the Canplatz example that I showed you, that actually was trading at 20 cents and went to $5 and now is at $2. So the risk reward there was very favorable. And so you do individual risk reward estimation for each of the stocks that you do. Then you have to get hands dirty. And this is a very traditional investment technique. It's not unique to discovery investing. Every good portfolio manager, every good analyst on Wall Street or in Toronto, they will do fundamental company analysis. And we use a 10-point grid, I'll show you in a moment, to delimit those points. So now you want to call the company, you want to read their annual reports, you want to talk to the directors, you want to go on a field visit with them, whatever it takes. Get on the phone and talk to these people and get to know the company so that you build some confidence in what they say and do. That's called fundamental company analysis. Then you rank them. I'll show you how to do that in a moment. In other words, what's my best name and what's my worst name? I've got 100 names in this thing. I'm going to pick the top 10, so I'm going to rank them from 1 to 100 and pick the top 10. And we use the 10-point grid to do that. And then you take the sentiment. It's like taking the pulse of the market. The sentiment analysis is like taking the pulse of the market. And just think about the market today. It really is a horrible market. People are afraid in the market. As I give you this lecture today, the sentiment is very negative about whether we're going to recover, when we're going to recover, whether we'll have inflation, whether we'll have deflation. And so lots of times the sentiment is, again, I mentioned the contrarian aspect of this. It's a good time to invest when the sentiment is negative because the stocks are cheaper. Then every week you want to rebalance your portfolio because things change. Even though you like a company and you fall in love with that company because you think they're going to have a great discovery, you have to continue to do this 8-step process almost continually, once a week, once a month, whatever you feel comfortable with, but frequently and continually so that you rebalance your portfolio. And some names get better, some names get worse, and then you buy and sell according to that. Finally, last but not least, perhaps most important, this is your roadmap for selecting each stock. So we talked about asset allocation, we've talked about sentiment analysis, we've talked about risk analysis. Now we're looking at the individual security. And here's how the grid works. So this is the 10-point discovery grid, and this is my analysis, but I think it works beautifully, and I've had quite a bit of success with this. First question you ask, very simple question. Is this discovery, whether it's a resource in the ground or whether it's an intellectual property, we call that an IP, or whether it's a new technology, does this have world-class potential? If we're talking about gold, is there possibly 10 million ounces here? Now you can't know that ahead of time, but you can ask the question, and you can figure out whether you have the potential for world-class. What does world-class mean? Exactly what it says. It's the best in its class. And if it is there, it will be worth a tremendous amount of money in terms of the stock price. The second question is very simple. What is the percent project ownership? Does this company own 100% of this with no encumbrances, and they have 100% of this project, and so there's no dilution in the project itself? I like to buy projects that are owned 100% by the company. Now, a lot of companies will joint venture with another company, and they'll end up being at 20% or 30%. But you really don't want to be there because you're going to be diluted down if you are. So you want to have companies that own 100% of this. Third question is, and I think this is kind of an important one, what I really want, because there are thousands of stocks out there, I want to have stocks that have game-changing, immediate potential. Okay, what do I mean by game-changing? Give you a couple of examples. Is this a possible cure for cancer? Yes or no? I mean, you don't know ahead of time, but is this discovery, this gene discovery that was made at the University of Waterloo, could this be a cure for cancer? And if the answer is yes, it could be, but we don't know yet, then that's got game-changing potential. That has the potential to change things dramatically. And just in the biotech space, you know that even treatments for cancer today that allow a longer life of a month to 2 months to 3 months are worth billions of dollars. Or maybe it's a food technology. Maybe it's a technology that makes it easier to grow wheat. You know, does that have game-changing potential? Absolutely, it does. This is a fun question to ask. This involves you with the process of discovery. And then I think the fourth question, and I try to keep this as simple as possible. There are actually 10 points here. You've got to get to know the management and the board of directors. Extraordinarily important. Actually, you make a lot of contacts if you do this, and they normally will answer your questions. Do they have a good track record? Has this management team been successful in the past? And do they own the stock themselves? Are they going to be in it with you as you go down the road here? And as they create wealth for themselves, they're going to create wealth for you. And are they buying? There's quite a few questions you can ask here. But are they buying the stock? That's a very, very important aspect. Now, when you look at a company, you ask these 4 questions and stop. And if the answer to these 4 questions is yes, then you go on. If the answer to any of these questions is no, I think, you put this stock aside and say, I'll look at it again, do some more work. But right now, these are important questions and I'm not getting the answers back that I want to get here. So that you simplify the process a lot. You don't have to know everything about a company. If it's not a world-class asset, if they don't own it all, and if it doesn't really have game-changing potential, and if the management team isn't top-notch with a good track record, you're wasting your time. So that, we try and simplify this process. Now, there are 6 other questions, and we'll go over these later, but, it's not really important, except that one of these questions I allocate 10 points, and I add it up, and so you get a score out of 100, and then you just simply sort all your stocks based upon their scores. And that gives you a very rough idea. So there are 6 additional points on the 10-point grid, but I'm not going to focus on those tonight. Yes, they're important, but what I try to do here is allocate up to 10 points for each one of these for each company, add them up, very simple process, take the total score for each company and sort from 1 to 100. And the ones that come at the top of the queue, then you get serious about those companies. Those are the companies you might want to buy. And financial soundness obviously is very important. Sustainability, because normally early in the discovery cycle, there's no cash flow. You've got to take that into consideration. It's a very important thought. But these are the 10 points on the 10-point grid, and believe me, if you do this well, you'll have a lot of fun with this, and it will work for you. Okay, now there are 3 classifications in my model of discovery stocks, and they're based upon the risk to reward trade-off. So if you look at the incubator section, and I'd just like to point out I own all of these stocks that are in here so that you're fully aware of that. I have owned all of them. I may not own all of them now, but some of them I do own because I've really enjoyed investing in them, and some of them have done very well. There are 3 different classifications. The incubator stocks are discovery incubation, and that's really the small, very small front end of the discovery space. These stocks are usually penny stocks, and after the market fall in the last couple of years, some of these stocks sell for 1 cent, 2 cents, 5 cents, 7 cents. So they're very cheap. So not much downside and a lot of upside. And then once the discovery is made, the stock moves from the incubator phase to the mature discovery phase. And so stocks in here, Quaterra Resources, Oil Sands Quest, Galway, and Endeavour Silver. and I own those stocks as well, and I followed those from the incubator phase to the mature discovery level. They all have discoveries, they all have assets, so they're in the next phase. Now, the key is you'll recognize here there's a lot less risk in these stocks because they've made their discoveries. And the prices are higher too. And then finally, of course, what you really aim for is the legacy. You'd like to buy a stock for pennies that's in the incubator phase, see it make a discovery, become a mature discovery, and then be taken out and go to the legacy phase where the asset actually goes into a large cap company. So in this case, some of the legacy discovery companies that you may decide to invest in Freeport-McMoRan, BHP, Goldcorp, Archer-Daniels Midland, Apple, Cleveland-Cliffs. These are not stocks that I own now, but they're examples of how assets could be discovered, incubated, matured, and then bought out. And of course, in that process, if you've been involved with that, you benefit because the wealth comes down to you. So that gives you a pretty good idea of, and what I find is some people enjoy investing at the incubator level. Some people would rather invest at the mature level. But this gives you the opportunity to decide what level you want to come in at in the discovery space. The key thing is, what is the discovery and what kind of wealth are we going to see from that? And finally, and last but not least, the Ultimate Canadian Incubator Fund. Yeah, there's a fund out there that does discovery investing, and it's run by a gentleman that I've come to respect, Tom McNeil, out of Saskatoon, Saskatchewan. It's called the 49 North Resource Fund. And his idea is to open up the Canadian markets, especially the market in Saskatchewan, to resource investors. So some of the stocks in his fund I would classify as in the incubator phase, very early on, very junior stocks. Some of them are mature, and some of them have done very well. This is an opportunity for you, for example, to be able to invest in a fund rather than to buy the individual stocks. I think this gives you a good overview and good probably for a first lecture on what discovery investing is. And what we'll try and do is come back in and talk about specific examples. We'll do some case studies in the next series of lectures so that you can actually put the knowledge that you're learning tonight to use. So thank you very much for your attention.
We are continuing our discussions here with Dr. Michael Berry, who happens to be in town for the tail end of the Cambridge show. You're getting ready to head off on a fishing trip soon.
I am.
That's going to be very exciting. I wanted to ask you, earlier today at the Cambridge show, Greg McCoach was on the podium, and he was talking about the utter disconnect that's happening in the United States right now. He fell short of calling the next shoe to drop civil war. But do you buy into the pretense that we're at the edge of the precipice with the American empire?
That's a difficult question. I think I buy into the notion that we will have a recovery. It will be slow and very, it'll be a tedious recovery, very, very difficult. And I think that whatever we go back to will be substantially a lower level of lifestyle than we've had in the past. So I don't think there's necessarily going to be civil insurrection or disobedience or armed insurrection or anything like that. I don't think we're there yet. But I do think that this has been a game-changing situation for the U.S. economy and for the United States.
You talked earlier in your discovery process for finding stocks that fit your model portfolio. You talked about the 3 stages.
Yeah.
And here in Canada, over the last 5 years, $450 million has gone into the ground in exploration, and there have been no new discoveries. What is the relationship with mining companies at the senior level looking and relying on the juniors for those discoveries? Is there a disconnect there?
I'm not sure it's a disconnect. I think that the senior mining companies, you know, the Freeports and the BHPs and the RTZs and so on, they tend to, I use a slang term, they tend to eat their young. In other words, they look at this pipeline, they look at what might be coming up the pipeline, and they buy them out. A good example was one that I worked on called Western Silver, which was taken out by Glamis. We discovered a lot of silver and a lot of gold in Mexico. That was taken out by Glamis, and Glamis in turn in the same year was taken out by Goldcorp. And so we all ended up with stock in Goldcorp, basically. So the good ones, the really good world-class assets, and you're absolutely right, there are very very few of those discoveries made, which is why you have to diversify in this space. But they get taken out by the big boys.
There is a saying in Vancouver, nothing ventured, nothing gained. The money that it takes to be a public company, do you feel over the next 18 months there is going to be a purging of the TSE and the TSX Venture Exchange?
I think that's a good statement. I think it's probably a true statement.
A
yes.
necessary evil?
Yeah, I think so. You know, we had between 2001 and 2000, and let's just say December of 2007, or maybe even July of 2008, we had a tremendous run up in the Toronto Exchange, in the commodity sector itself, and a lot of these companies were really hurt. Especially the little companies were hurt by the credit crisis in the U.S., and it went around the world very quickly. Asset prices fell, commodity prices fell, housing prices fell, everybody got hurt. So I think there'll be a pretty good shakeout. But that presents an opportunity because a lot of the properties that are now being held by companies that aren't strong are going to be available. So what happens is you winnow down the crop of junior explorers, and you end up with a lot of good things out there that people will ultimately come back in and invest in.
You are a behavioral strategist, but your background as a multi-cap wearer from a lot of different jurisdictions in terms of mindsets and education. You were a former fund manager. If you could just identify for our audience, what is the PhD in?
PhD is in financial economics from Arizona State University. And I have a bachelor's degree in mathematics from the University of Waterloo in Waterloo, Ontario. So it was natural for me in the 70s. All of finance was very, very mathematical in orientation. And so I've actually gone through the process of being a mathematician and then a financial economist with modeling expertise. And then I worked with a lot of psychologists who really know how to do investing. So, you know, I switched over into the behavioral field, and the behavioral part of investing is even more powerful and more important than the mathematical part.
I'm going to ask you to do something special for me, and that is pick one greatest invention of the last 20 years. And it can't be duct tape.
One greatest invention. Well, I'd call it a discovery. I think in general, I'll give you a general, and then I'll try and go to specific. But generally, I think the work that's being done in gene technology is going to be the greatest invention in the last century, maybe in the last 5 centuries. We're understanding how genes work and how cells work. But if I had to pick one that's now in play, in 1973, I worked for Honeywell in computers. I was newly out of school. They sent me to MIT, and I worked on the ARPANET. The ARPANET eventually became the Internet. Mm-hmm. I'd have to say, in my experience, of something that, that is probably the greatest invention. It's been the most productive invention of the last 20 or 30 years.
When you come back and complete Series 2 with us at the sit down at this table, back in the 80s, Tears for Fears wrote a song called Advice for the Young at Heart. Are you going to come back and give us some more advice for the young investors?
I'd love to.
All right.
I'd love to do that. Okay.
Our guest has been Dr. Michael Barry, and this is Mining Interactive.